$900 million from its own coffers, a sum equal to the bank's entire capital, and to raise a further $600 million with a margin loan secured against Allied stock. Campo even succeeded in borrowing the $300 million of equity he had promised to put into the $4 billion bid. On top of these loans, over $1 billion worth of junk bonds were issued to finance the acquisition. Because Allied did not generate sufficient cash to service the interest payments on these debts, First Boston issued on Campo's behalf $250 million worth of pay-in-kind preferred shares, that is, securities that paid dividends with loan notes rather than cash. The total bill for the acquisition of Allied came to $4.1 billion. In March 1987, Allied succumbed to Campo's bid. Its chief executive was dismissed, complaining bitterly of having been blindsided by a trainload of clowns, although he got a $15 million golden parachute. The bankers received fees totaling more than $500 million, and a financial Hitler, to use the description of one of his advisers, found himself in charge of America's second-largest department store group. The novel financial practices involved in the Allied takeover, in which banks staked their entire capital on strangers, debt could not be serviced without asset sales, bonds paid interest in yet more bonds, and advisory fees exceeded the equity investment of the investor, were hailed by Wasserstein as the dawn of a new era of merchant banking. The October Crash. On the 25th of August 1987, the Dow Jones Industrial Average closed at 2,746, up 43% on the year. Although sentiment remained bullish into the early autumn, with Morgan Stanley advising its clients to have 100% of their investment portfolio in stocks, the flow of funds to the market faltered. In preparation for a massive $35 billion issue of shares in Nippon Telephone and Telegraph, Japanese investors started repatriating funds. As U.S. bond yields were rising on fears of inflation and the dollar was falling against the yen, Japanese investors were also losing heavily on their massive investments in treasury bonds, which they now began to sell. This further depressed the price of bonds and made shares, trading on a multiple of 23 times earnings, look increasingly overvalued. With the yield on Treasury bonds at over 10% by the beginning of the second week in October, there followed a spate of unsettling reports. Treasury Secretary James Baker was threatening to let the dollar go into free fall unless the German Bundesbank lowered interest rates. On Tuesday the 13th of October, the market buzzed with the rumor that Congress planned to end the tax breaks favorable to leveraged buyouts. The following day, a larger-than-expected U.S. trade deficit was announced. On Friday, reacting to the news that a tanker carrying the U.S. flag had been hit by an Iranian missile in the Persian Gulf, the market dropped 108 points, its largest points fall ever. The same day, the London Stock Exchange remained closed after a freak hurricane tore through southern England. Earlier in the week, Elaine Garzarelli, a research analyst with Shearson Lehman, had forecast on cable news network an imminent collapse in the stock market. It was to prove, in the words of Business Week, the call of the century. The international stock market crash of Monday the 19th of October 1987 rose with the sun in the east. Hong Kong, Malaysia and Singapore, followed by several of the European markets, were all down heavily while New York slept. When the New York Stock Exchange eventually opened at 9:30 on Monday morning, there were no bids for many of the large stocks. Half an hour later, only 25 of the 500 stocks in the Standard & Poor's 500 index, representing America's largest companies, were trading. If people were unable to sell shares, they could at least sell stock index futures at the Chicago Mercantile Exchange. Concentrated selling of futures, however, caused futures to drop to a discount to shares traded on the big board. In normal circumstances, arbitrageurs would have acted to close the gap by buying futures and selling shares, but this day the volatility was too great for arbitrage, and the markets became uncoupled. Instead, a vicious circle operated as panic selling of futures caused the stock market to drop, which in turn induced further sales of futures. Shortly before noon, the press reported that the head of the Securities and Exchange Commission was considering a trading halt. People hastened to dispose of stocks while the market remained open. The turbulence of October 1929 had been caused partly by the forced liquidation of margin accounts. In October 1987, an avalanche of computerized program selling was to blame. The sales were induced by portfolio insurance, a fashionable and supposedly fail-safe investment strategy which dictated buying when stocks rose and selling when they fell. Funds managed by portfolio insurers had increased rapidly during the year to reach an estimated $90 billion. In the 3 trading days before the crash, portfolio insurers unloaded nearly $4 billion worth of stocks on a falling market. On Black Monday, in the hour after 1 o'clock, they were responsible for over half the sales of the stock index futures at the Chicago Mercantile Exchange. Portfolio insurers were contracted to make their sales in the futures market, so that even when futures fell to a discount to the stock market, they continued selling there. Aggressive traders, anticipating these sales, jumped on the bandwagon and sold stocks short. By the market's close, portfolio insurers had sold the equivalent of $4 billion worth of stocks in the futures market, 40% of the day's total volume. The panic on that day was similar to countless former stock market panics. A trader at the Merc fled his post, withdrew his life savings from a bank in the foyer, and disappeared over the horizon in his Porsche. Several other traders sold their seats at the Merc, whose price crashed along with everything else. In the White House, a senior administrative official was witnessed running down the corridor shouting, "It's in free fall!" As in 1929, the technology of the market began to collapse. On the New York Stock Exchange, the automated trading system broke down, its printers could not cope with the flood of selling, and brokers were left unable to confirm trades. The new derivatives markets performed no better. Owing to extreme volatility, it became impossible to price stock options, and the options market dried up. When the markets closed, the indexes told the story. The Dow Jones Industrial Average was down 22.6%, the S&P 500 down 20.5%, and the S&P futures contract down nearly 29%. Turnover on the big board exceeded 600 million stocks, worth $21 billion, almost double the record set the previous Friday. A similar amount had been traded in the futures market. 2 venerable New York Stock Exchange member firms, E.F. Hutton and L.F. Rothschild, failed, along with nearly 60 smaller brokers. For many, the collapse of the market appeared to threaten a systemic financial crisis, possibly the end of capitalism. The financier Sir James Goldsmith, who had recently sold most of his assets in anticipation of a crash, compared his feelings at the time to winning a rubber of bridge in the card room of the Titanic. Goldsmith's anticipation of doom was exaggerated. On Tuesday, the 20th of October, after a sharp initial decline and the temporary closure of the futures market at the Merc, the stock market climbed sharply. This rally was assisted by actions of the Federal Reserve, which provided extensive liquidity to the financial markets in order to avert a banking crisis. Several major companies, urged on by telephone calls from the White House, announced they would buy back their shares. Conspiracy theorists later suggested that the recovery was engineered by the authorities, who had closed the futures market at the Merc in order to manipulate stock prices. Whatever its causes, the recovery effectively ended the panic. By the end of the year, investors who had held their stock positions since January were even able to record a modest profit, despite having lived through the greatest crash in percentage terms in history. Although a total of $1 trillion was knocked off American stock market values during the month of October, the panic of 1987, unlike that of 1929, was not followed by an economic crisis. The reason for this, according to some commentators, is that the 1987 bull market was not really a retail market, attracting ordinary members of the public. So when share prices collapsed, the effect on public confidence and consumption was slight. Andrew Smithers, an English economist, offers another explanation. He claims that the crash of 1987 did not produce a recession because stock prices were not actually overvalued at the time. Using a measure of valuation known as the Q ratio, devised by the American Nobel laureate James Tobin, which compares the market capitalization of companies to the replacement cost of their factories, plants, and other assets, Smithers shows that even at their peak in August 1987, share prices were only slightly above their long-term average. If the mild aftermath of the 1987 crash remains an enigma to many, it was interpreted by the exponents of efficient markets as proof that speculative booms and stock market panics were rarely, if ever, the cause of depressions. Political venality and the savings and loan crisis. The leveraged buyout boom was made possible by the deep-seated laissez-faire attitude of the Reagan administration, which dissuaded the Federal Reserve from applying margin restrictions on buyouts. At some point, principled laissez-faire gives way to a widespread acceptance of shortcuts in the pursuit of self-interest, and from there it is but a short step to outright dishonesty. As the Reagan years progressed, a fog of corruption gathered over Washington, reminiscent of the Gilded Age or the Harding presidency in the early 1920s. By the spring of 1987, more than 100 officials appointed to federal posts during the Reagan administration had been accused of misconduct. Many of the nation's political leaders were prepared to sell themselves to the highest bidder in exchange for campaign contributions. Milken brazenly told the Washington Post in April 1986 that the force in this country for buying high-yield securities has overpowered all regulation. That year, Drexel raised $500,000 in campaign contributions for Senator Alphonse D'Amato, chair of the Subcommittee on Securities of the Senate Banking Committee, who had previously supported restrictions on hostile takeovers. After this donation, it was observed that D'Amato's disposition towards junk bonds underwent a remarkable transformation. Political venality, dogmatic deregulation, and speculative opportunism combined explosively to produce the savings and loan scandal of the late 1980s. The savings and loan associations, known colloquially as thrifts or S&Ls, were local banks originally created to provide mortgage loans to American homeowners, a role idealized in Frank Capra's movie It's a Wonderful Life, in which James Stewart played an honest and dependable thrift manager. By the early 1980s, however, many of these institutions were in trouble. In particular, they suffered from the deregulation of interest rates, which obliged them to pay higher rates for short-term deposits, especially high during the Volcker squeeze on inflation, when they had already lent for long periods at low fixed rates. The Reagan administration's prescription for the thrift's ills was a large dose of deregulation. First of all, thrifts were freed from dependence on local customers' deposits and permitted to borrow funds wholesale from Wall Street money brokers. At the same time, federal deposit insurance on individual S&L accounts was raised to $100,000. Second, they were encouraged to diversify their loan portfolios to reduce their reliance on the local housing market. The Garnes-St. Germain Bill of 1982 removed restrictions on thrift loans, allowing them to invest in junk bonds, property deals, and almost any other speculative venture that took their fancy. On signing the bill, President Reagan commented, "I think we have hit a home run." Important changes were made to thrift accounting rules. They were permitted to sell off bad loans without taking an immediate charge against profits. This was called euphemistically loss deferral. On the other hand, anticipated earnings on real estate investments could be reported. Property development loans of up to 100% of appraised value were permitted. In short, virtually every rule in the book of prudent banking was either flouted or struck off. Depositors might have been wary of these developments and removed their cash to safer havens had their deposits not been guaranteed by the federal government. Deposit insurance more than dulled depositors. It positively encouraged them to seek out the highest rates offered by the shakiest institutions. In the words of one commentator, it was the crack cocaine of American finance. While depositors remained in a state of somnolence, savings and loan managers reacted swiftly to these changing circumstances. They proceeded to take the thrift out of thrifts. In California, seminars were held informing them how to use the new legislation to get rich quick. Formerly sober thrift managers started speculating in collateralized mortgage obligations. Warned of the risks involved, one of their number retorted that hedging is for sissies. Many savings and loans invested heavily in junk bonds. Thomas Spiegel, a former Drexel salesman who ran a California thrift, Columbia Savings and Loan, was particularly close to Milken, who took a large stake in his business. As the junk market took off, Spiegel expanded his bank's balance sheet from under $400 million in early 1982 to $13 billion 5 years later, of which nearly a third was invested in junk. Operating from an office in Beverly Hills, close to Drexel's bond department, Columbia participated in all of Milken's biggest deals. Spiegel enjoyed the good life. He purchased 2 corporate jets and paid himself a $9 million salary in 1985. Another junk bond buying bon vivant of the savings and loan world was David Paul, a former house builder who ran the SunTrust Savings Bank of Miami. Paul bought $1.4 billion worth of junk bonds and a similar amount of unrateable speculative bonds from Drexel, which had earlier helped finance his takeover of SunTrust. Paul paid himself $16 million, took an apartment at the Carlyle Hotel in Manhattan, and spent $1.4 million a year on a corporate jet, $13 million on a painting by Rubens, and $8 million on a yacht. Called Le Grand Cru, it came with gold leaf ceilings and a jacuzzi in the master suite. While the yacht and the art collection appeared as assets on the bank's balance sheet, junk bond losses went discreetly unreported. The behavior of the Texas savings and loan operators was even more unreal. They expanded their loan books by an average of over 1,200% a year, lending mostly on speculative property deals. Their business interests did not prevent them from enjoying the finer things in life. For instance, Don Ray Dixon of Vernon Savings took his wife by private jet and Rolls-Royce on a market study of French Michelin 3-star restaurants. In return, she penned a report for the bank entitled Gastronomie Fantastique. He also bought 6 jets, a vintage car dealership, and the sister ship to President Roosevelt's yacht. Another operator, Edwin Fast Eddie McBurney of Sunbelt Savings, fed his guests at his North Dallas home on lion meat and antelope, while presiding over the festivities dressed as Henry VIII, with dry ice billowing around him. At another party at his penthouse suite in Las Vegas, McBurney allegedly diverted his bank's clients with an enthusiastic lesbian romp, while prostitutes performed fellatio on favored guests. Milken's web of contacts in the savings and loan world was complex. For instance, the Southmark Corporation, a conglomerate which issued junk through Drexel and bought the San Jacinto Savings and Loan Association of Houston in order to finance real estate deals, became the landlord of another of Milken's clients, Circus, a Las Vegas casino operator. Southmark was connected with MDC Holdings of Denver, which owned Silverado Savings and Loan, and also issued junk bonds through Drexel. McBurney's Sunbelt Savings held Southmark and MDC bonds in its junk bond portfolio. By far the most notorious of Milken's many contacts in the thrift world was Charles Keating, head of Lincoln Savings and Loan of Irvine, California. A former swimming champion, Keating had once worked as a lawyer for Carl Lindner, the business tycoon and corporate raider. In 1978, he purchased from Lindner a large house-building company, whose name he changed to American Continental. 5 years later, Drexel issued junk bonds and preferred stock for American Continental, retaining a 10% stake in the company for itself. With this money, Keating bought Lincoln Savings and Loan. On taking control of Lincoln, Keating fired the thrift's senior management, increased its supply of funds from Wall Street money brokers in order to grow the bank rapidly, and commenced speculating in risky securities and property deals. Keating put $100 million into Boesky's arbitrage partnership. In the spring of 1985, he backed Sir James Goldsmith's leveraged bid for Crown Zellerbach, the paper company. He made real estate deals in Texas and Arizona with the Southmark Corporation and Fast Eddie McBurney. In his dealings with Wall Street, Keating embarked on loss-making foreign exchange deals with Credit Suisse, purchased the junkiest of junk bonds from Drexel, and speculated in stock options and shares, using a supposedly fail-safe computerized trading system developed by Salomon Brothers, which nevertheless lost several $1 million. Facilitated by the deregulation and lax banking supervision of the Reagan years, Keating resorted to numerous accounting tricks to conceal his mounting losses. In 1986, he issued unsecured bonds for American Continental, which he distributed to Lincoln's customers, many of whom believed, wrongly, that the bonds carried a federal guarantee. Although reckless in his speculations, Keating displayed great care in cultivating politicians and regulators. He provided campaign funds to 9 senators and several congressmen, and offered lucrative jobs to several of Lincoln Bank's regulators and auditors. At one point, he even succeeded in getting a man heavily in debt to Lincoln appointed as commissioner to the bank board, the body ultimately responsible for regulating Lincoln's affairs. If he couldn't bribe bank regulators with employment, Keating threatened them personally with lawsuits. He hired the economist Alan Greenspan, later chairman of the Federal Reserve, to support Lincoln's application to increase its direct investments to more than 10% of assets. In a letter he must have come to regret deeply, Greenspan wrote to the California bank regulator that the management of Lincoln and American Continental was seasoned and expert, with a long and continuous track record of outstanding success in making sound and profitable direct investments. When regulators discovered that Keating was concealing losses and had exceeded the regulations on direct investments, he used his friendly senators, later dubbed the Keating Five, to browbeat the head of the bank board. For over 2 years, Keating successfully fended off the regulators. Finally, in the spring of 1989, Lincoln was taken over by the authorities. At a press conference held after the event, Keating announced, "One question, among the many raised in recent weeks, has to do with whether my financial support in any way influenced several political figures to take up my cause. I want to say in the most forceful way I can, I certainly hope so." In similar manner, other thrift operators secured their freedom of action with political contributions. On his yacht, Don Dixon of Vernon S&L held fundraising parties for Jim Wright, the Speaker of the House, and several other leading Democrats. The golden rule, according to a lobbyist for the Texas thrifts, was that he who has the gold makes the rules. Never mind that the gold was borrowed with a federal guarantee. By the end of the decade, the fastest-growing thrifts had accumulated staggering losses on their loan and investment portfolios. The bailout of Silverado Savings and Loan alone cost over $1 billion. Over 1,100 thrifts failed as a result of their imprudent practices, and the American taxpayer was left to pick up the bill, amounting to around $200 billion. But for the presence of federal deposit insurance, the very policy which had encouraged their reckless speculations, the collapse of the thrift industry would most probably have led to bank runs, followed by a credit contraction and asset deflation similar to that of the 1930s. The end of the decade. The junk bond mania continued into 1988. It was said that shortly after taking control of Allied stores, Campo, while on holiday in Florida, came across a Bloomingdale's store, whereupon he threw up his arms and declared, "This is the store I should have bought." His bid for Bloomingdale's parent, Federated Stores, was launched in late January 1988. A contest developed, but Campo had no limit. He secured the company at a cost of nearly $11 billion, with his own equity investment limited to less than $200 million. Bankers' fees for the transaction exceeded Federated's annual earnings. Shortly after the Federated takeover, Campo ordered a lavish leather-bound book to be produced, with photographs of his buildings and stores. In the introduction, America's greatest department store magnate expounded his vapid philosophy. "Because we can be no more than we aspire to be, we will aspire to be more than the best of what we are." The quality of junk bonds declined progressively as the gap between an LBO company's earnings and the interest payments on its junk bonds was whittled away. As a result, a slight decline in income would send the junk bonds into default and the company into bankruptcy. In order to conceal the fragility of this situation, Drexel and other investment banks issued more accrued interest securities, such as pay-in-kind and zero-coupon bonds, which, because they paid interest with corporate paper rather than cash, delayed the initial impact of interest charges on a company's cash flow. The amount of equity invested in LBO deals also declined. James Grant calculated that in 1987 and 1988, equity investment in LBOs averaged less than 4%. Some companies, such as Dr. Pepper, the soft drinks manufacturer, went through multiple buyouts at ever-increasing prices. Warren Buffett was reminded of a New Yorker cartoon in which a grateful borrower tells his bank manager, "I don't know how I'll ever repay you." On a more serious note, Buffett warned investors that, in the end, alchemy, whether it is metallurgical or financial, fails. A base business cannot be transformed into a golden business by tricks of accounting or capital structure. Ultimately, the health of the junk bond market rested upon an unwavering faith in Michael Milken. Unfortunately, the chief alchemist was removed from the scene just when his inspirational presence was most needed. Shortly after his arrest, Ivan Boesky had implicated Milken in order to lighten his own sentence. In September 1988, Milken and Drexel were charged with violating a number of securities laws, including those against racketeering, market manipulation, insider trading, and stock parking, that is, executing false trades between parties in order to avoid taxes. After initial resistance, Drexel conceded to certain charges and agreed to pay a fine of $650 million and fire Milken. Milken initially proved more obdurate. In the spring of 1989, along with his brother Lowell and another Drexel associate, Milken received a 98-charge indictment which carried a potential maximum sentence of over 500 years and limitless fines. Shortly after, in exchange for clemency for his brother, Milken arranged to plead guilty to a few minor felonies. A full trial, which might have provided a definitive exposition of Milken's role in the junk bond mania and ascertained the full extent of his criminality, was avoided. On the 21st of November 1991, Milken was sentenced to 10 years' imprisonment. His fines totaled over $600 million. At the time of his conviction, it was disclosed that between 1985 and 1987, Milken's cumulative earnings exceeded $1.2 billion. This revelation led the press to caricature the shy banker as Money Mad Mike. To many, Milken's 10-year sentence appeared a suitable punishment for his part in the decade of greed. Naturally, his lawyers did not see it this way. Describing the case prepared against the financier by the U.S. Attorney's Office under Rudolph Giuliani, Milken's lawyer, Arthur Lyman, stated, "I am convinced that society needs a certain number of demons." The case took on the characteristics of a heresy trial. Milken had become a symbol, the symbol of an era, and it was beyond any kind of control. While it is true that Milken was indicted for relatively minor offences, having escaped by plea bargaining the more serious charges, and that, contrary to popular perception, the great bulk of his fortune was derived legitimately from his uncommonly generous remuneration package, Milken was not the innocent scapegoat portrayed by his legal team and PR advisors, whose budget ran to many millions of dollars. His total control of the junk bond market turned him and his fellow Drexel traders into bullies and braggarts. Corners were cut in the pursuit of profit. The lust for money and power created a collective adrenaline rush that fed upon itself, until Milken and Drexel became insatiable. Like Sir John Blunt in 1720, Milken overreached himself and brought about his own downfall. A greater degree of probity than Milken displayed has always been demanded from those who aspire to be great bankers. Perhaps the best way to judge Milken's career is through the unfolding of events in the junk bond market. The leveraged buyout craze reached its zenith in early 1989, with Kohlberg Kravis Roberts' $26 billion takeover of RJR Nabisco, the food and tobacco conglomerate, an episode described by Anthony Bianco, a financial journalist, as resembling Der Ring des Nibelungen, directed by Mel Brooks and starring a collection of ornery, steely-eyed midgets in the guise of gangsters. Time magazine simply called it a game of greed. The collapse of the junk bond world followed shortly after. In April 1989, Charles Keating's American Continental filed for bankruptcy. On the 15th of June, the day that Milken was sacked, Integrated Resources, a Drexel client, defaulted on its junk bonds, whereupon it became known as disintegrated. In July, Congress passed a bill requiring savings and loan associations to dispose of their junk bond holdings. 2 months later, the Campo Corporation, not a Drexel client, admitted it could no longer pay the interest on its bonds. It was as if, wrote the financial journalist James Stewart, the nation's investors had awakened from a decade-long dream and recognized finally that high returns could not be realized without increased risk. When the proposed buyout of United Airlines fell through in October 1989, the junk bond market collapsed and the Dow fell by 6%. A couple of months later, both the Campo Corporation and Integrated Resources sought bankruptcy protection, along with the Jim Walter Corporation, a Kohlberg Kravis Roberts buyout. Its balance sheet heavy with depreciating junk bonds, Drexel Burnham Lambert found itself unable to roll over its short-term debts. Its numerous Wall Street enemies refused to come to Drexel's aid. On the 13th of February 1990, the bank that had epitomized the 1980s financial culture joined its clients in bankruptcy. During the next 12 months, 2 of Milken's largest junk bond buyers, Fred Carr's First Executive, an insurance company, and Thomas Spiegel's Columbia Savings and Loan, also failed. It was a sorry legacy for the empire of a man once hailed as the successor to Pierpont Morgan. The corporate raiders had enjoyed lambasting incumbent managements, complaining typically that senior executives had no stake in the businesses they ran. Yet most of the raiders' stakes were composed of borrowed money. The debts were serviced by sacking workers and cutting other operating expenses, and by reducing ongoing investments. This might lead to increased efficiency as flab was cut from a company, but it could also seriously weaken its competitive position, as has been the case with RJR Nabisco. When the timing was right, as with Perelman's takeover of Revlon and Kohlberg Kravis Roberts' acquisition of Beatrice, the gains for the raiders were mouth-watering. When the timing and execution were poor, as with Campo's venture into the department store business, the losses for the creditors were excruciating. The junk bond revolution was based on a profound asymmetry between risk and reward, with junk bond purchasers taking most of the risk and takeover entrepreneurs snaffling most of the rewards. In fact, the movement for leveraged buyouts represented the return of the large speculative margin loan through the back door. For instance, Robert Campo acquired control of an $11 billion company with an equity investment of only $200 million. Since he actually borrowed the equity portion, the margin loan was close to 100%. Examined in this light, the returns of Kohlberg-Kravis-Roberts for its investors look less than impressive. Leon Cooperman, a Goldman Sachs partner, calculated that holding a selection of stocks on 85% margin during the bull market of the 1980s would have yielded annual profits of nearly 75%. Using similar leverage, KKR achieved returns for its investors of only 60%. Yet these returns were sufficient to make vast personal fortunes for the firm's partners. Once the figures could be examined, it became clear that, contrary to Milken's gospel, junk bonds had considerably underperformed investment-grade bonds. Not only were the returns lower, but the risks were far greater than Milken's initial analysis had suggested. The rate of default on junk bonds rose to around 9% in the early 1990s, more than 4 times the historic average. The change in the rate of default demonstrates what George Soros has termed the reflexivity of the financial markets. As investors came to share Milken's belief that junk bonds provided better returns, their relative quality declined until they became the worst and most speculative investments. Milken's thesis for junk bonds resembles E. L. Smith's case for equity investment in the 1920s. Both were based on sound statistical analyses of past returns, yet the validity of their conclusions was vitiated by subsequent manias. Commenting on Milken's original case for junk bonds, based on their historic outperformance, Warren Buffett observed, "If history books were the key to riches, the Forbes 400 would consist of librarians." Michael Milken received his sentence on the very day Mrs. Thatcher was toppled from power. It was widely expected that after the excesses of the 1980s, the speculative spirit would wane as it had done after the 1920s. In retrospect, the crash of 1987 sent out a radically different message to the events of 1929. The market's recovery appeared to show that buying and holding stocks was the best investment strategy, and that stock market crashes did not herald economic depressions. Instead, they provided an opportunity for bargain basement purchases by canny investors buying into the dip. If a runaway stock market train hit the buffers at high speed, the Federal Reserve would always be there to sort out the mess. If the banks messed up, deposit insurance guaranteed that the taxpayer would end up paying. Portfolio insurers, it is true, suffered public censure and disappeared from the scene. Exponents of the efficient market hypothesis kept their heads down, but only for a short while. A few years later, 2 number-crunching academics produced an analysis suggesting that the 1987 crash had been a chimera, a mathematical aberration, a chance event whose odds against recurrence were 10 to the power of minus 160 to 1. Even if one were to have lived through the entire 20-billion-year life of the universe, they concluded, and experienced this 20 billion times, 20 billion Big Bangs, the probability that such a decline could have happened even once in this period is a virtual impossibility. Chapter 9. Kamikaze Capitalism, the Japanese Bubble Economy of the 1980s. By your patience, ancient pistol, Fortune is painted blind, with a muffler afore her eyes, to signify to you that she is blind. And she is painted also with a wheel, to signify to you, which is the moral of it, that she is turning and inconstant, and mutability and variation. And her foot, look you, is fixed upon a spherical stone, which rolls and rolls and rolls. In good truth, the poet makes a most excellent description of it. Fortune is an excellent moral. Shakespeare, Henry V, Act 3, Scene 6. Central to the body of thought known as Nihonjinron, which roughly translates as the theory of the Japanese, is the idea that Japan is unique. Perceived differences between Japan and the West were sometimes invoked by the Japanese authorities in order to hinder the import of foreign goods. For instance, Japanese intestines were said to be different from those of Westerners, and therefore unsuited to foreign beef and rice. It was even claimed that American skis were useless in Japan because the snow was different. At other times, pointing out such differences became a barely concealed expression of Japanese cultural nationalism and xenophobia. The Japanese brain was said to have a heightened sensitivity to the sounds of nature and a more intricate understanding of social relationships. The Japanese distrusted Western-style rationalism as being incompatible with the preservation of wa, social harmony. They recognized a distinction between honna, a private intention or thought, and tatemai, a public version of the truth, and considered both to be equally valid. Japanese reason was described as wet, like the cloying rice of the national diet, which formed the glue of the community, while Western reason was dry and individualistic. Even in the ethical sphere, the Japanese were said to be different. They did not feel guilt, only shame on public revelation of misdeeds. At the root of all these differences, both real and spurious, lay a profound distrust of individualism, which found its counterpart in a strong attachment to community and deference to authority. The Western model of capitalism is primarily individualistic. Self-interest directs the invisible hand, which holds the system together. Because self-interest cannot be directed by authority, Adam Smith described the market system as that most compatible with a state of civil liberty. The centrality of self-interest to Western capitalism dictates a number of economic policies: a confined role for government in economic affairs, a distrust of monopolies and cartels, and the protection of the individual, whether operating as a tradesman, entrepreneur, capitalist, or consumer. Laissez-faire prescribes that markets should be left to find their natural level, while the law of comparative advantage enjoins governments not to protect their domestic industries from foreign competition. Japanese capitalism is in many respects the antithesis of the Western model. Until the middle of the 19th century, Japan remained a feudal economy, closed to the outside world, with no tradition of legal rights for the individual. When the Japanese authorities of the Meiji era decided to modernize their country following the arrival of American warships under Commodore Perry in the middle of the 19th century, they borrowed selectively from the West to build a new economic system. The hierarchy of the feudal system, however, remained in place. It was simply transferred from an agricultural base to a corporate industrial one. The peasant who had formerly bowed to his feudal lord now served a corporate master. Even after the Second World War, it was common for a worker to be called by the name of his company. For instance, if he worked for the country's largest car manufacturer, he might be known to his friends as Toyota-san, Mr. Toyota. Employees were required to sing the company song and even worship at the company founder's shrine. In exchange for their devotion and self-sacrifice, employees were rewarded by their companies with lifetime employment and promotion according to seniority. The primacy of the company in the Japanese system was recognized by the authorities, which encouraged the creation of industry cartels and huge industrial groups, known as zaibatsu. When the zaibatsu were partially dismembered by the American occupation forces after the Second World War, they were replaced by less formal groupings, known as keiretsu, in which outright ownership gave way to an intricate system of cross-shareholdings. In Japanese capitalism, the role of the authorities was traditionally wide-ranging, though undefined. Officials at the Ministry of International Trade and Industry, MITI, and at the Ministry of Finance controlled industries through an informal process known as administrative guidance, a system of persuasion and intimidation based on the bureaucrats' powers to license companies, provide tax concessions, distribute government contracts, and so on. In the post-war era, MITI decided which industries to support and which companies would enjoy a privileged position within an industry cartel and receive protection from foreign competition. The Ministry of Finance guarded the financial sector and ensured that cheap loans were channeled from Japan's thrifty savers to its cash-hungry and highly leveraged corporations. As interest rates were kept artificially low by these arrangements, and companies generally paid only small dividends, returns for Japanese investors were poor. Indeed, the term Japanese capitalism is misleading, since capital did not actually determine the nature of the system. The domestic consumer was similarly exploited by the Japanese system. Imports were restricted by a variety of measures, and it was common for Japanese manufactured goods to sell for a higher price in Tokyo than in New York. The Japanese prided themselves that their system was less selfish and more stable than the West. They boasted that they were long-termist, while the West pursued only short-term gains. Japanese companies were more interested in market share than profitability, and paid more attention to administrative guidance and their keiretsu obligations than to their returns on capital. Under this system, the role of the market was severely restricted. One Western commentator declared that the Japanese have never really caught up with Adam Smith. They don't believe in the invisible hand. The individualistic pursuit of self-interest was deplored, and a distrust of trade lingered. While money was recognized as the source of power in politics, samurai tradition emphasized the virtues of frugality. In pre-war Japan, the nouveau riche were dismissed as narikin, a Japanese chess term for a pawn promoted to a queen, an object with no hierarchical right. Hierarchy remained the essence of the system. Employees had a defined position within their corporate hierarchy, and companies were ranked within their keiretsu, which in turn took its place in the hierarchy of the Keidanren, the Federation of Economic Organizations. Speculation is antithetical to a state-directed economic system such as existed in Japan. It is inherently short-termist and seeks the maximization of gain, while the Japanese system was professedly long-termist and considered other economic objectives, such as the development of favored industries, more important than mere profit. Speculation also involves the transference of risk, but after a stock market crash and numerous bank collapses in the 1920s and early 1930s, it was declared that the Japanese authorities would never again tolerate such failures. As a result, risk was socialized in Japan to a far greater degree than in the West. Nevertheless, speculation came to Japan in the 1980s. It burrowed so deep inside the Japanese system that when it departed, after a mere 5 years, the system was in ruins. Officials tried to pick up the pieces and reconstruct the old order, but their efforts were in vain. This was the real legacy of the bubble economy. Winning the peace. Speculative euphoria is often a symptom of hubris. For this reason, we find great speculative manias at times when the economic balance of power is shifting from one nation to another. For instance, the tulip mania appeared in Holland shortly after the Dutch economic miracle, which saw Amsterdam established as the entrepot of the world. In similar fashion, a stock market boom occurred in New York at the beginning of the 20th century, when the United States overtook Britain as the world's leading industrial power. For more than 3/4 of a century, America stoutly maintained its economic primacy, but by the middle of the 1980s, its position was threatened by the growing might of Japan. Japan's share of world trade was over 10%, its trade surpluses were burgeoning, the nation's capital exports invited comparison with those of Britain in the 19th century, and Japanese per capita income was in the course of exceeding American levels. Japan's industrial companies dominated new technologies in consumer electronics and a number of other fields, and its banks were the largest in the world in terms of both assets and market value. America was on the run. While Japan had its trade surpluses, America faced growing trade deficits. The Reagan administration also produced enormous budget deficits that were only sustained by the willingness of Japanese investors to sink their country's trade surplus into U.S. Treasury bonds. In Detroit, angry auto workers destroyed Japanese cars in protest against imports. The New York Times warned that today, 40 years after the end of World War II, the Japanese are on the move again in one of history's most brilliant commercial offensives, as they go about dismantling American industry. Assailed by commentators who told them they were balefully short-termist and suffering from chronic individualism, Americans lost some of their self-confidence. It was claimed that the United States was threatened by an economic Pearl Harbor. A book entitled Japan as Number One became a bestseller on both sides of the Pacific. The Japanese also invested their trade surplus in purchasing U.S. assets other than treasury bonds. American property was a particular favorite with Japanese investors. After the Mitsui Corporation acquired the Exxon building in Manhattan for a record price of $610 million in 1986, it was reported that Mitsui's Japanese president had paid $260 million above Exxon's asking price in order to see his name in the Guinness Book of World Records. Given the extravagance of many Japanese overseas acquisitions, this story appeared credible. As the decade progressed, the Japanese snapped up other icons of American capitalism, most notoriously New York's Rockefeller Center and Hollywood's Columbia Pictures. This deluge of Japanese capital revived the fierce xenophobia that Americans had formerly displayed towards their wartime adversaries. American anxieties over the Yellow Peril, expressed in scaremongering works including Susan Tolchin's Buying into America, 1988, and Daniel Burstein's Yen, Japan's New Financial Empire and Its Threat to America, 1989, found their broadest audience with Michael Crichton's best-selling novel Rising Sun, which was published at the height of the Japan is buying up the United States hysteria. Crichton told the New York Times that he had written the novel to make America wake up. American fears were matched by a revival of Japanese self-confidence, sweetly enjoyed after the deeply felt humiliation of military defeat and the long sacrifices undertaken to rebuild the shattered nation. A newfound self-assurance was evident in the posturing of Japanese politicians. In the autumn of 1986, Yasuhiro Nakasone, the newly elected Prime Minister, ascribed the success of the Japanese economy and the relative decline of the United States to his nation's racial homogeneity compared with America's racially mixed workforce. Such comments echoed the wartime propaganda that had asserted the superiority of the Yamato race. Several leading members of the government even publicly visited the Yasukuni shrine where the war dead were honored, while Nakasone himself proclaimed that the nation must shed all sense of ignominy and move forward seeking glory. Having lost the war and discarded its dreams of a Pacific empire, Japan had finally won the peace and emerged as an economic superpower. Under the circumstances, hubris was perhaps inevitable. Zytec, corporate speculation. Japan could not avoid being sucked into the vortex of the financial revolution that followed the breakup of the Bretton Woods fixed currency system in 1971, an event, incidentally, which President Nixon blamed on Japan, whose chronically undervalued currency had undermined the system. In 1980, Japan liberalized its exchange controls. Even so, the pace of reforms was too slow for many American critics, who argued that continuing restrictions in the Japanese financial system were part of a deliberate policy to keep the yen below its natural level, thereby making Japanese exports cheaper. In fact, the liberalization of the financial system was not simply the result of American pressure. Japan was obliged to reform its financial markets in order to recirculate the excess capital accumulated by its rising trade surpluses and sustained by its high savings rate. Although the Japanese authorities could not avoid the financial revolution, they hoped that reforms would enable Tokyo to emerge as a global financial center, taking its rightful place alongside New York and London. In the spring of 1984, the Japanese authorities agreed to allow foreign banks to deal in Japanese government bonds and enter the trust banking business. At the same time, controls on foreign exchange trading were removed. For the first time, Japanese banks were allowed to set their own rates of interest on large deposit accounts. As a result of these reforms, Japan's capital markets were quickly filled with the detritus of the financial revolution. Canadian and Australian TUFAs, reverse dual currency bonds, samurai and sushi bonds, instantly repackaged perpetuals, zero-coupon bonds, square trips and double-dip leveraged leases, euro-yen bonds, and harakiri swaps. Financial derivatives also came to Tokyo with the opening of futures markets for Japanese bond and stock indexes. In the early 1980s, Japanese companies began supplementing their ordinary earnings with the extraordinary profits derived from Zytec, financial engineering. In 1984, the Ministry of Finance permitted companies to operate special accounts for their shareholdings, known as tokin accounts. These accounts allowed companies to trade securities without paying capital gains tax on their profits. Brokerages also offered a semi-legal service managing special speculative accounts for companies, known as Eigyo tokin, on which they guaranteed a minimum return above the current rate of interest. The game was fixed to ensure they would emerge winners. In 1985, just under 9 trillion yen was invested in tokin funds. 4 years later, the figure had risen to over 40 trillion yen, $300 billion. Zytec speculation was facilitated by Japanese companies' access to the Eurobond market, the offshore capital market based in London. As part of the process of financial deregulation, in 1981, the Ministry of Finance gave Japanese companies permission to issue warrant bonds in the Eurobond market. These financial instruments combined with conventional corporate bonds with an option, the warrant, to purchase shares in the company at a specified price before the expiry date, normally set 5 years after issue. Since Japanese share prices were rising sharply, increasing the value of the warrants, companies were able to issue bonds with very low interest payments. Warrant bonds were also attractive to their issuers for another reason. They were mostly issued in dollars that were subsequently exchanged in the swaps market for yen. Because the yen was expected to appreciate over the life of the loan, swapping a dollar liability for a yen liability could result in a negative interest payment by the company issuing the warrant bond. In other words, Japanese companies were actually paid to borrow money to finance their speculations. Money raised from warrant bond issues could either be invested directly in the stock market or placed in an Eigyo tokin account with a guaranteed return of 8%. Zytec was a game with no losers. In the second half of the 1980s, the profits from corporate speculation soared, along with the Japanese stock market. This created a dangerous circularity in the financial system. Zytec manufactured profits, causing share prices to rise, which further increased Zytec gains. By the end of the decade, most of the industrial companies listed on the Tokyo Stock Exchange were engaging in Zytec. Over half the reported profits of the largest players, internationally renowned companies such as car manufacturers Toyota and Nissan, and consumer electronics firms Matsushita and Sharp, were derived from speculation. Total corporate gains from tokin accounts rose from 240 billion yen, $2 billion, in the year to March 1985, to 952 billion yen, $7 billion, 2 years later. Few cared that during the same period ordinary operating profits actually declined. In certain cases, the speculative activities of companies came to dominate their business. A steel company named Hanwha, known as the Gnome of the East, raised over 4 trillion yen, $30 billion, in the late 1980s for Zytec, and its profits from speculation grew to exceed its earnings from ordinary trading activities by 20 times. Not all the new capital raised by Japanese companies in the late 1980s was poured into speculation. Warrant bonds also financed what has been described as the greatest wave of investments in productive capacity the world has ever seen. In the second half of the 1980s, capital investment in Japan amounted to $3.5 trillion, accounting for 2/3 of the country's economic growth. This massive burst of investment helped the Japanese economy pass through a difficult period, when the stronger yen was causing both lower growth rates and declining returns on capital. Some commentators have suggested that the Ministry of Finance deliberately called into being the bubble economy in order to supply cheap capital for Japanese industry at this critical time. The capital expenditure of the bubble years created the illusion that Japan's economic miracle was continuing long after its real vigour had diminished, and produced a vast misallocation of resources into unproductive investments. By attempting to use speculation as a tool of economic policy, the mandarins of the finance ministry had opened a Pandora's box. The land standard. The bubble economy, or baburu as the Japanese called it, was first and foremost a property boom. Land holds a special position for the Japanese. Its ownership continued to convey status in a society not long released from feudal servitude. Japan is a mountainous country where development land is relatively scarce. There were other reasons for high Japanese land prices. Punitive capital gains taxes, designed by the bureaucrats to encourage long-termism, taxed short-term property gains at 150% of the profits. By discouraging the sale of land and creating an illiquid property market, the fiscal system actually stimulated land speculation. Some Western commentators even suggested that high property prices, which turned the Japanese, in the words of Sir Roy Denham, a former European commissioner, into a nation of workaholics living in rabbit hutches, were part of a covert government policy to encourage savings which could then be ploughed back into the industrial machine. Between 1956 and 1986, land prices increased 5,000%, while consumer prices merely doubled. During this period, in only 1 year, 1974, did land prices decline. Acting on the belief that land prices would never fall again, Japanese banks provided loans against the collateral of land rather than cash flows. Towards the end of the 1980s, they increased lending against property, especially to smaller companies. The rising value of land became the engine for the creation of credit in the whole economy. Tochihon Nissei, the land standard, had arrived. In early December 1987, at a meeting of the Bank for International Settlements in Basel, Switzerland, representatives from the world's central banks gathered to set new international standards for banking capital. Because Japanese banks were protected from failure by the Ministry of Finance, they had traditionally operated with a lower capital adequacy ratio, a safety cushion measured by the ratio of a bank's assets to its loans, than their Western counterparts. Foreign bankers were concerned that lower capital reserves gave Japanese banks an unfair competitive advantage in global banking, and demanded that they conform to conventional international levels of banking capital. As a result, Japanese banks were obliged to raise their capital ratio to 8% by the spring of 1993. An important concession, however, was secured by the Japanese representatives at Basel. As part of the web of cross-shareholdings peculiar to the Japanese system, their banks owned a large number of shares in other companies. It was agreed that a certain proportion of the profits on these shareholdings could count towards Japanese banking capital. As a result of the Basel Agreement, Japanese banks' ability to increase credit, in other words, to manufacture money, became linked to the level of share prices in the Tokyo stock market. Everything else being equal, if the banks increased their property lending, the value of land and shares — Japanese companies were increasingly valued according to their property assets — would climb. Rising share prices would increase the value of the bank's cross-shareholdings, inflating their capital and enabling them to lend more. The world's central bankers had endorsed a circular arrangement by which credit creation could continue as long as stock prices rose. This was the fatal flaw of the bubble economy. The Plaza Accord. In the mid-1980s, the economic policies of Japan were the opposite of those of the United States. Japan had a tight fiscal policy and a loose monetary policy, while America combined a tight monetary policy with a loose fiscal stance. High interest rates in the United States, intended by the Federal Reserve to keep inflation at bay, had the unwelcome effect of creating a strong dollar that hindered exports and increased the American trade deficit. American exporters noisily demanded assistance from their government. Since the dollar was overvalued and the yen undervalued, floating exchange rates should theoretically have solved the problem. In practice, they needed a little prompting. In September 1985, U.S. Treasury Secretary James Baker gathered the finance minister of the world's leading economic powers at the Plaza Hotel in Manhattan. Spurred on by Baker, the ministers agreed to act in concert to push down the value of the dollar in relation to other currencies, in particular the yen. A few months later, the dollar sank to under 150 yen, from an earlier high of 259. Viewed from another perspective, the purchasing power of the Japanese currency had risen by over 40%, and everything priced in dollars was that much cheaper to anyone with yen in his pockets. The great Japanese shopping spree, from Louis Vuitton handbags to Van Gogh paintings, was set to commence. There was, however, an immediate downside to the yen's appreciation. Ever since April 1949, when the American banker Joseph Dodge fixed the yen exchange rate against the dollar at 360, the Japanese currency had been consistently undervalued in the foreign exchanges. In the 1970s and early 1980s, higher rates of inflation in the United States than in Japan combined with a stable exchange rate to produce in real terms a continuous devaluation of the yen. This was of great assistance to Japanese exporters, the powerhouses behind the country's economic miracle. After the Plaza Accord, the situation changed. Japanese goods in the international marketplace were suddenly nearly twice as expensive. The threat to Japan's economy was palpable. In early 1986, as economic growth slipped below 2.5%, the talk was of Endaka Fukyo, the strong yen recession. Exporters warned of a hollowing out of the economy as the yen rose inexorably against the dollar. Urgent action was required, and Japanese companies looked to the all-powerful Ministry of Finance for a solution. The ministry, in turn, put pressure on the officially independent Bank of Japan to reduce interest rates in order to stimulate the economy. During 1986, the official discount rate was cut on 4 occasions until it reached 3%. Since the price of oil was falling and imported goods were cheaper due to the strong yen, the faster monetary growth that followed did not feed into consumer price inflation. Instead, the price of assets, land and shares started to rise. By August 1986, the Nikkei index had reached 18,000, up nearly 40% since the start of the year. This sharp rise stimulated the public's interest in economic matters. A manga, comic book, on the Japanese economy, published by the Nihon Keizai Shimbun, Japan's leading financial newspaper, went to the top of the bestseller lists. At the end of the year, the Far Eastern Economic Review reported that, suddenly, stocks have become a national street-level preoccupation. Against the background of a rising market, the government launched its long-awaited flotation of Nippon Telephone and Telegraph, NTT, the national telephone company. In October 1986, an initial 200,000 shares in the company were offered to the Japanese public. At the time, foreigners were forbidden by NTT's articles from holding its shares. Within 2 months, nearly 10 million persons had applied for shares, even though the government had yet to announce the issue price. Popular demand was so strong that the shares had to be distributed by a special lottery. On the 2nd of February 1987, NTT's shares floated freely on the Tokyo Stock Exchange at a price of 1.2 million yen per share. In the first 2 days of trading, their price soared by 25%. At the end of February, the group of 7 finance ministers meeting at the Louvre in Paris agreed to stop the dollar from sliding any further against the yen. Following this agreement, Japanese interest rates were cut to a post-war low of 2.5%, where they remained until May 1989. The effect on share prices was electrifying. Within a few weeks, NTT's share price was at 3.2 million yen, valuing it at over 200 times annual earnings. The telephone company's market capitalization was now more than 50 trillion yen, $376 billion, larger than the combined value of the West German and Hong Kong stock markets. Seeing the frenzy for NTT's shares, the company's chairman, Hisashi Shinto, remarked casually to a reporter, "One day people engaged in the money game are going to incur the wrath of God." The privatization of NTT was reminiscent of the South Sea subscriptions in 1720. Both privatizations were intended to improve the public finances. On each occasion, the public applied for shares before being informed of the price, and a speculative bubble followed, with both companies' share prices rising above rational levels. Most significantly, in 1720 and again in 1987, speculators were led to believe that the government would not allow the share price to fall. When the second tranche of NTT shares were issued in November 1987, the Japan Economic Journal observed that the popularity of NTT is attributed to individual investors' beliefs that since the government made the public offering, it would not inflict losses on the people. Individual investors consider they are buying Japan itself when they buy NTT shares, so they buy them without apprehension. When the Japanese stock market bounced back after the October crash, it was widely believed that political protection had been granted, not just to NTT, but to the stock market as a whole. Money politics. Japanese politicians were not solely guided by public duty in their desire to support the stock market. They also maintained a private interest in its continuing ascendancy. In Japan, the conduct of politics had become an expensive business. It was calculated that the annual expense of maintaining a seat in the Japanese Diet was around 400 million yen, $3 million. Cash was the primary source of power in Japanese politics. It bound factions together, purchased ministerial seats, procured favors, and bought votes. In the style of Tammany Hall bosses in the Gilded Age, Japanese politicians looted the stock market to fill their own coffers. During elections, political shares, seiji kabu, were pushed by securities houses. This enabled politicians who had previously invested in them to take profits and pay their election expenses, after which the shares were allowed to decline. During the bubble years, shares became a supplementary currency for the conduct of the nation's money politics. This added further support to the notion that politicians would never allow the stock market to fall. The deep involvement of politicians in the stock market was revealed to the public by the Recruit Cosmos scandal. In June 1988, a minor public official in the city of Kawasaki resigned after he admitted using inside information to buy shares in Recruit Cosmos, the property subsidiary of a fast-growing employment agency. Recruit's chairman was an ambitious businessman named Hiromasa Ezoe, who had made extensive gifts of shares to a number of politicians, businessmen, and bureaucrats in order to forestall planned legislation detrimental to the interests of his company. In late December 1988, Takahishi Hasegawa, the newly appointed justice minister brought in to investigate the Recruit scandal, was forced to resign after only 4 days in office, when it was revealed that he had received shares in the company. The finance minister also stepped down. A few months later, the Prime Minister, Nobura Takeshita, finally admitted to profiting by 150 million yen from the sale of Recruit Cosmos shares. Takeshita's political secretary, who had received the money on his master's behalf, hanged himself. The net gradually widened to catch other big fish, including former Prime Minister Nakasone, the chairman of NTT, and the president of a major newspaper, the Nihon Keizai Shimbun. By the summer of 1989, nearly 50 politicians, civil servants, businessmen, and journalists had been exposed by the scandal. Western commentators wondered whether crony capitalism might not be an apt description of the Japanese system. Recruit Cosmos was the greatest political scandal in post-war Japan. It showed political venality to be an integral aspect of the bubble economy. The rising stock market had initially reflected Japan's newfound feeling of economic prowess. The nation's growing self-confidence was appropriated by politicians for nationalistic purposes. Later, bureaucrats stimulated public speculation in order to assist Japanese companies in raising cheap capital during a difficult transitional period. A thriving stock market enabled the government to solve its fiscal problems by selling shares in an overpriced telephone company to naive investors caught up in the euphoria of the bubble. In the background lurked the systemic corruption of Japan's money politics, which utilized speculation to service its fathomless financial demands. Speculation ran amok because no one in a position of power had any interest in controlling it. The Americans, who feared that Japan threatened an economic Pearl Harbor, were correct in one sense. The militaristic hubris that took Japan blindly into the Second World War found its counterpart in the speculative hubris of the bubble economy. History was repeating itself, except this time a stock market farce replaced the tragedy of war. Values in the Japanese stock market. During the late 1980s, Japanese share prices increased 3 times faster than corporate earnings, which included the unsustainable profits derived from Zytex speculation. The Tokyo stock market flaunted some of the most overvalued shares in history. The textile sector sold for an average of 103 times earnings, services companies for 112 times earnings, marine transportation businesses for 176 times earnings, and fishery and forestry firms for a staggering 319 times earnings. Japan Airlines, in the process of privatization, sold for over 400 times annual earnings. Western investors, who believed that such values were not justified, gradually reduced their Japanese shareholdings from the mid-1980s onwards. Their departure meant the market was no longer constrained by Western rationalism, with its dry reasoning of discounted cash flows and credit analysis. The Japanese, on the other hand, with their tendency to accept the version of reality disseminated by authority, had no trouble justifying the lofty values found in their stock market. A number of soothing explanations were given for high share prices. Japanese accounting practices understated real earnings, cross-shareholdings inflated price-earnings measures, and so on. Even the more conservative analysts, unmoved by claims that Japan was becoming the locomotive of world growth, or that an explosion in consumer demand was around the corner, nevertheless pointed to the weight of money argument to justify further advances in share prices. According to this idea, since interest rates remained low and the rising yen discouraged investors from taking their money abroad, the Japanese people were left with no alternative but to continue investing in the domestic stock market. This argument was reinforced by the abolition of tax-exempt postal savings accounts in April 1988, which released over 300 trillion yen, $2.25 trillion, for new investment. The massive flow of Japanese savings into the stock market, combined with the scarcity of shares, caused by a gradual increase in the level of cross-shareholdings, became the most frequently cited explanation for stratospheric share prices. The prevalent disregard for the fundamentals of value during the bubble years showed itself in a variety of ways. Shares of companies in the same sectors moved together, regardless of individual differences in earnings performance and prospects. The market rewarded increases in market share rather than rises in profitability. Some shares were hyped for no other reason than that they were affordable in relation to the multi-million yen NTT share. Cheap shares, it was argued, would one day catch up with the more expensive ones. Stocks not only rose on new issues, when the ownership rights of existing shares were diluted, they also climbed sharply when companies announced a bonus issue of shares, although by simply splitting its shares, the company did not create any real value. Shares continued rising despite the declining profitability of Japan's exporters and the hollowing out of its manufacturing base. When Emperor Hirohito died in January 1989, they rose. When a small earthquake hit Tokyo 6 months later, they also rose. Behind all the rationalizations for rising share prices lay the reality of an extraordinary real estate boom. Property prices climbed on an ever-increasing supply of credit. Total bank lending increased by 96 trillion yen, $724 billion, in the 5 years to March 1990. Over half this sum went to small businesses, which invested heavily in the property sector. Loosely regulated consumer credit companies, the non-banks, increased property loans from 22 trillion yen in 1985 to 80 trillion yen, $600 billion, by the end of 1989. On occasion, loans were provided for up to twice the collateral value of properties. As property prices climbed, the average lifetime earnings of a graduate salaryman, office worker, became insufficient to buy even a small apartment in central Tokyo. House buyers were forced to take out multi-generational 100-year mortgages. By 1990, the total Japanese property market was valued at over 2,000 trillion yen, or 4 times the real estate value of the entire United States. The grounds of the Imperial Palace in Tokyo were estimated to be worth more than the entire real estate of California, or Canada if you preferred. Low vacancy rates and the demand for office space from foreign financial institutions led to a building boom in Tokyo, where the number of cranes rising over the bay were eagerly counted. Analysts talked of the crane index. When NTT opened a high-tech skyscraper in central Tokyo, with offices at over $3,000 a square meter eagerly taken up by foreign bankers, it became known affectionately as the Tower of Bubble. With property in the Ginza district valued at 50 million yen a square meter, plans were hatched to build an underground city in Tokyo at a depth of 100 meters. Inflation in the property sector had a direct impact on the stock market. The search for companies' hidden assets, which included both the value of land holdings and cross-shareholdings, became the fashionable pursuit of analysts. An economist at the University of Tokyo revived the Tobin-Q ratio, which examined the ratio of stock prices to the market value of company assets. Japanese companies appeared cheap by this measure, since by 1988 they had latent capital gains, or hidden assets, on their balance sheets worth 434 trillion yen, $3.3 trillion, above book value. In a reversal of a trend common to most speculative manias, the trading prospects of high-tech firms were ignored in favor of the property on their balance sheets. The brokers called them land plays. Even NTT was valued primarily for its land assets rather than as a telecommunications company. Propelled by its extensive land holdings, the market value of Tokyo Electric Power increased in 1986 by a greater value than that of all the stocks listed on the Hong Kong Stock Exchange. All Nippon Airways, another land play, soared to a price-earnings ratio of nearly 1,200. More than 3/4 of the land owned by companies was kept for the purposes of capital appreciation. The Japanese corporation, with its cross-shareholdings and hidden land assets, had become a combination of investment trust and property company. In such circumstances, normal business activities were considered an irrelevance, or at worst, a drag on stock market values. Manipulation in the Japanese stock market. Although there were many predictions of a Japanese stock market crash, most notably by George Soros, the hedge fund manager, in a Financial Times article on the 14th of October 1987, it was Tokyo that best weathered the global stock market crash a few days later. The day after the October crash, representatives of Japan's largest brokerages, Nomura, Daiwa, Yamaichi, and Nikko Securities, collectively known as the Big Four, were summoned to the Ministry of Finance. They were ordered to make a market in NTT shares and keep the Nikkei average above the 21,000 level. Complying with this request, the brokers offered their most important clients guarantees against losses in order to encourage them to re-enter the market. Within a few months, the Nikkei had recovered its losses and was progressing to new heights. In private, Ministry of Finance officials boasted that manipulating the stock market was simpler than controlling the foreign exchanges. Among them, the Big Four accounted for over half the turnover of the Tokyo Stock Exchange. The most powerful of their number was Nomura Securities, which during the bubble years became the most profitable company in Japan and amassed liquid assets of over $400 billion. Nomura had 5 million loyal domestic customers, mainly Japanese housewives, who daily put their savings into special Nomura piggy banks, played stock market computer games on Nomura software, faithfully followed Nomura's stock tips, no sell recommendations were ever issued, and every week handed over their money to one of Nomura's thousands of salesmen. Every month Nomura staff were given a sales quota to fill, and every morning they were told which stocks to push. During the second half of the 1980s, around 8 million new investors entered the stock market, taking their total number to over 22 million. Although they owned only a small percentage of the market's total capitalization, the majority of shares being tied up in corporate cross-shareholdings, private investors bought and sold more than 100 billion shares each year. Encouraged to speculate by their brokers, private clients held a third of their stocks in margin accounts. Despite a traditional horror of gambling, which they see as a Chinese vice, two related national characteristics made the Japanese particularly susceptible to the lure of the stock market. First, they have a tendency to exhibit herd-like behavior when pursuing a certain activity, whether at work or at play. This was said to stem from the communal demands of rice farming, which had fostered a national Shudankisuku Ishiki, group consciousness. During the war, Japan was portrayed in government propaganda as 100 million hearts beating as one. After the October crash, the president of a securities house boasted that Japan had survived the period of volatility because it was a consensus society, a nation that likes to move in one direction. Second, the Japanese psyche is particularly prone to mood swings, shifting abruptly between elation and despair. These national weaknesses were exploited ruthlessly by brokers, who pushed a series of stock market themes, which provided the focal points for speculation. The speculative crowd blindly pursued the red lantern, Akaichochin shares that were enticingly placed before them. The most prominent theme was the redevelopment of Tokyo Bay, which highlighted the property potential of many companies. It was followed by a series of stories hyping untried technologies, such as linear motor trains, superconductivity, cold nuclear fusion, and miracle cancer cures. After a Kobe prostitute died of AIDS in early 1987, there was a fever of interest in condom stocks. Despite the fact that 3/4 of Japanese adults already used rubber contraceptives, oral contraception being forbidden, the share price of Sagami Rubber Industries quadrupled. When Nippon Meat Packers was rumored to have extracted an anti-AIDS agent from chicken bile, its shares rocketed. Perhaps in anticipation of safe-sex alternatives, shares in pornographic film companies also climbed during the AIDS scare. In a report entitled Theme Chasing, the Engine of the Tokyo Stock Market, an American investment bank advised its clients, "A herd instinct is a sound survival instinct in an environment of excess liquidity." Through their large shareholdings in the press, the Big Four brokers were able to manipulate the information available to their clients. During their weekly meetings, the same brokers were said to collude in choosing which shares to promote. As the stock market itself was awash with rumors and tips, brokers found their clients highly susceptible to manipulation. In the words of the Far Eastern Economic Review, the Tokyo Stock Exchange was the most cynical, speculative, and manipulable stock market in the world. Despite the inexorable rise of the market, the average private client made little money. He remained an outsider, fodder for the brokers and their favored clients. Churn and burn was said to be Nomura's unwritten motto. Many private investors placed their money in investment trusts run by affiliates of the large brokerages. These trusts were churned mercilessly for commissions, and produced average annual returns of less than 4% in the late 1980s, at a time when the market was rising by over 20% per annum. The only reliable way to make money during the bubble was on the inside. Favored clients, bankers, bureaucrats, politicians, rich individuals, and even yakuza, gangsters, were informed beforehand which stocks the brokers intended to push. Brokers guaranteed the investment returns of insiders and compensated them for losses. Favored clients who had lost heavily in the market were supplied with ambulance shares, stocks certain to rise, to heal their financial wounds. Since brokers habitually pushed stocks prior to the announcement of new shares issues, the information that a company was under-financing became a license to print money. Although there was a law against insider trading, no one paid any attention to it. The speculator's web. The Japanese economic system was sometimes described as an example of network capitalism, with an iron triangle of politicians, bureaucrats, and corporations at its core. The bubble economy produced its own alternative network, with speculator groups, gangster organizations, banks, stockbrokers, and politicians joined together in the common pursuit of speculative profits. Since the majority of shares were tied up in long-term cross-shareholdings between companies and banks, it was relatively simple to manipulate share prices and corner stocks. A Tokyo Stock Exchange report claimed that 1 in 10 listed companies was cornered between April 1987 and March 1989. Greenmail, the practice of buying into companies and demanding to be bought out at a premium, became increasingly common. Although Al Capone is reported to have avoided the stock market because he thought it a racket, the Japanese yakuza gangster of the 1980s was less fastidious. During this period, the Inagawa Kai, Japan's second-largest crime syndicate, was run by Susumu Ishii, a tall, distinguished-looking man with elegant manners and a reputation for intellectualism, uncommon among brash Japanese gangsters, who generally favored loud pinstripe suits and large American cars. Having recently completed a 6-year prison sentence for illegal gambling activities, Ishii was seeking to reduce his gang's dependence on its traditional sources of income, derived from drug running, brothels, protection money, and pachinko, pinball halls. The bubble provided him with the perfect opportunity. In early 1985, Ishii founded a real estate company, Hokusho Sangyo. This company was supplied with loans and loan guarantees by a large trucking firm, whose president was linked to the powerful faction leader Shin Kanemaru, the Don of Japanese politics. Having provided himself with the necessary funds and political protection, Ishii began his ambitious speculations, funneling around 170 billion yen, $1.3 billion, into the stock market. He built up large positions in a variety of concerns, including Tokyo Gas, Nippon Steel, and Nomura Securities. In 1987, his investment vehicle had earnings of over 12 billion yen, a 50-fold increase on the previous year. He commissioned a new headquarters on land costing 15 million yen, $113,000 a square meter, and spent an estimated 10 billion yen, $7.5 million, on paintings by Renoir, Chagall, Monet, and others. In the spring of 1989, Ishii attempted to corner the stock of the Tokyu Corporation, a large railway and hotels business. For this move, he received the assistance of 2 of the Big Four brokerages, Nikko and Nomura, which lent him 36 billion yen, $270 million, on the security of Tokyu's shares. The fact that Tokyu was also a Nomura client does not appear to have bothered the broker. Between April and November 1989, Ishii bought 29 million shares in Tokyu, 2/3 of these supplied by Nomura and Nikko, while the remainder came from a shady Korean businessman, Ho Chung-yong, who was connected with Japan's largest crime syndicate, the Yamaguchi Gumi, and later became the central figure in the Itoman art fraud scandal. In the course of the operation, Tokyu's share price doubled. Ishii became the model for the corporate gangster or economic yakuza who emerged during the late 1980s. In a society where public confrontation is a source of acute embarrassment, the Yakuza used their powers of intimidation to muscle into every area of the bubble economy. They joined in many stock market corners and green mailing operations, borrowed heavily from financial institutions, especially from the non-bank affiliates of the major banks, and acted as loan sharks to other speculators. Gangsters were also active in the property market, where jiageya, as they were called, intimidated smallholders into selling their properties by threatening them with firebomb attacks. Occasionally the game turned nasty. In the summer of 1985, a Nomura branch manager was beaten to death by gangsters who had sustained losses in a biotech speculation. 3 years later, the body of the president of Cosmo Securities, a well-known speculator and green mailer, was discovered encased in concrete. He had been murdered by Yakuza associates. Outside Yakuza circles, there were an estimated 40 powerful speculator groups, which maintained interests in some 200 companies. Half a dozen professional speculators, shitesuji, were rumored to control shareholdings worth more than $5 billion apiece. The most prominent and powerful of these was Mitsuhiro Kotani, a self-made hotel and golf course operator and head of the Koshin speculation.